you're looking at capital allocation first and foremost, and the evidence of capital allocation. None of these companies really pay dividends. They don't want to because they're getting high returns on their capital. If they start paying dividends when they're still getting high returns, you've got to question what they're doing. Are they trying to appease Wall Street? Now you look at their pattern of share buybacks. Are they doing them at all? And when are they doing them? You take a company like Fairfax in Toronto, they buy back stock when it falls below book value. And then when it gets way above book value, they issue shares. They've been doing that to increase book value. It says it's another tool they use. Berkshire Hathaway will buy back shares if the stock gets near book value or beneath what they think is intrinsic value. If they're waiting for those types of moments to buy back shares, that tells you something about rationality. We have a lot of companies that claim to aspire to be Berkshire lookalikes, but when I see them buying back stock at 30 times earnings, it tells me no, they're not really following the discipline. If they're making stupid acquisitions and paying too much for acquisitions and trying to build value just by accreting one company on top of another, but always paying a high price, they're not going to get the rates of return. And it's going to show up eventually in terms of impairment charges. It's going to show up in terms of slowdown of the company. It's going to show up in terms of one day the earnings are going to crash of the company. And these are things that just haven't happened to companies like Markel or Berkshire or Brookfield Asset. And that tells you you've got just well-disciplined managers in there. And on the insurance front, what you want to look for is when are they writing premiums and new business and when are they not. If markets are what they call hard in the insurance market and premium prices are going up, you want to be able to have the capital and zip in there and increase your premiums and your policies in force by 20% in a certain year. And conversely, if you have a soft market and premiums are falling because there's just too much competition and too many folks getting into that business, you want to see that these companies are throttling back. They're letting these policies roll off and they're not renewing them. And they're willing to take a hit on the revenues and the operating profits and their combined ratios for a couple of years just to wait for better markets. And if you see that, that's the best evidence you can get that these companies are disciplined and they're putting capital to work when you should put it to work, when times are bad. And that's what that ultimately comes down to. When blood is in the street, if you've got the staying power and put money to work, you're going to get a higher return than people who don't. And we know it's just human nature to want to put money to work at the top. Everybody does. Investors do it. Corporate CEOs do it. They're flush with cash, at the wrong time of the business cycle all the time, and that's when they go out and make acquisitions. The best managers wait until hard times. They wait until the phone rings and, from a desperate seller says, will you pick up my business? Will you pick up my portfolio? Here's what you can take it off my hands for this. Please take it off my hands for this. And they're waiting there and they have the discipline to say, yes, I can do it. And conversely, when times are really good, they will just walk away for a couple of years and not buy anything. If you see a steady pattern of that within these companies, you got something really, really nice working in your favor.